Thank you for joining tonight's edition of You and Your Money. I'm Bryan Hirsch, and this evening we're going to be dealing with various tax matters. With the national budget just a week away, all eyes are on tax and how any changes could affect your wallet, your investments, and your financial decisions in the year ahead. I'll be hosting a program on the 25th of February to unpack the major announcements and what they mean in practical terms. In tonight's program, I'd also like to highlight the complications I regularly encounter when a parent passes away and leaves assets to children living abroad. In many cases, these children emigrated from South Africa years ago, although many of them qualified professionally. They never went on to earn income locally, which often creates unexpected tax exchange, control, and estate administration challenges when inheritances are distributed. And joining me this evening is Werner Voss, tax specialist at Davy Voss Tax Practitioners, to help make sense and advise of some of the actions should be considered. It's important to understand that everyone's circumstances are different, and before making any decisions, I suggest you consult with a tax specialist. Werner, thank you for joining me. It's good to have you on the show.
Good evening, Bryan.
Yeah. Werner, let's first talk, and in simple terms, what does it actually mean to break tax residency?
Bryan, that's when you leave the country with the intention to permanently settle down elsewhere. But
Werner, you know, people who've left many years ago, and I think about many of the people I look after, and quite a few of these states I'm busy winding up. There's always been a problem. At least 1 to 2 of the children are living abroad. They left many years ago. Some of them left where they'd never worked here. Some did work here. And so what are the tax reasons why people break residency?
Well, apart from other obvious reasons like security and many other factors, from a tax point of view, why people would break residency is usually to obtain tax certainty. In other words, so that you don't end up being taxed on the same income by 2 countries at the same time. The other important reason is the ability to access your retirement annuities. And other reasons would be for the ability to remove income from South Africa as opposed to capital without the need for a tax clearance certificate. And maybe another reason is for some people, the high rate of tax is a reason to leave the country.
Okay, so let's break that up into 2 categories. One, someone's left, never worked here, they've been living abroad for many, many years, they've got families living abroad, and they've still got parents here, and on death the parents leave assets to it. The other is where they left, maybe having spent 20 years working here, they've got retirement annuities, they've got property here, and they've got other issues that they still do a tax return. So let's deal category 1, they've left the country. Would they have been ever responsible for doing a tax return?
Bryan, it depends on whether they've got a tax number. Some people, as you pointed out earlier, studied and then left the country. Now, those people shouldn't have tax numbers in South Africa. So for them to transfer funds abroad, for example, in the inheritance context, that would be very easy. The regulations, the exchange control regulations actually says that the authorized dealer, being a bank in South Africa or a local bank, is allowed to transfer inheritances, if I can use that as an example, to transfer funds abroad once they've established that the person is a non-resident and once they've had sight of the liquidation distribution account. Then in that case, no permission is needed to transfer funds abroad. The problematic scenario in that context, Bryan, is really when someone studied, started working here, and then got a tax number. In those cases, it becomes very difficult to get money out of the country because you will notice from the bank's point of view, example, in an inheritance case as well, is they'll say, well, you've got a tax number, you have a South African ID number, we cannot transfer funds abroad without a tax clearance certificate. And that's where this break of residency certificate comes into play.
So Werner, I think of accountant students, did articles, so therefore they were in employment during the years of articles, so they would have received a tax number. So now they left South Africa. Was it a requirement that they had to continue submitting tax returns?
Well, there's not a requirement to submit returns. I mean, if we look at the factual inquiry here, is that when you're a non-resident, you do not have to declare non-resident income in South Africa. Because remember, we have two ways of taxing people in South Africa and many other countries in the world. We have a residency-based system and we have a source-based system. So in that particular case, if there was no SA sourced income and you're not a resident, there's no need to declare income or submit returns. But the reason why people end up submitting returns is really a condition on the bank side, because the bank says without the certificate or being in good standing, in other words, filing all those zero returns over that period of time, if you haven't had any income in South Africa, you have to go through that process in order to get a tax clearance certificate.
So Werner, so let's talk about it. Someone who left South Africa, not a problem, we can transfer the assets freely. But those who've worked here 15, 20 years, even 10 years, and now they've left, the first requirement, were they required each year to file a tax return?
Bryan, let's assume you've broken residency. The only criteria to submit a tax return in South Africa is if you have SA sourced income. So technically, if you have no SA sourced income, there's no need to declare and submit returns. But remember, the trick here is it's not a tax problem, it's more of an exchange control problem. Because the banks will not allow you to transfer funds abroad unless you can prove to them that you're in good standing with SARS.
Okay, so Werner, hold on. Someone who's sold a property, or rather left a property and left and rented it out, or someone who's in receipt of retirement income, both of those are passive, would they still have been required to have submitted a tax return to SARS?
Yes, it is, because both in the retirement annuity case and the rental income case, the source of the income is SA based or SA sourced, and for that reason you have to file returns.
Even if it's under the threshold?
The normal conditions, the normal arrangement with submission of tax returns says that if you only have one source of income, let's look at the annuity scenario. If you only have one source of income and it's below 500,000 Rand a year and you do not want to claim any expenses against it, you're not required to file.
And in the property case? Is it the same?
In the property case, you have to file because you've got income that you have to disclose, and obviously there would be a need to claim expenses against that profit as well, or against the income. The profit obviously will then be subject to tax in South Africa if it's over the tax-paying threshold.
Okay, so now the concerns that I find is the second scenario you've painted, where we've had to get tax returns. So now your bank account's been closed, you've left, you've been gone, and all of a sudden you receive inheritance. Now we have to break tax residency to be able to get that money out. Now the two concerns obviously about tax residency is, one, do you end up giving up your passport? And two, are you still allowed to transfer the 1 million Rand out that's allowed? You don't have to get foreign exchange approval.
Okay, so on your first point, Bryan, when you break residency, that is a status that gets updated with the receiver of revenue, SARS, as well as the Reserve Bank, because a lot of the Reserve Bank functions have been taken over by SARS. However, if it comes to your citizenship side of it, that is a home affairs matter, and it's absolutely a standalone from tax. So in other words, it's quite possible to be a tax non-resident in South Africa, from a South African point of view, but you still hold a South African passport, and you can continue renewing your passport every year. So absolutely, you do not give up your citizenship, and you continue renewing your passport as and when you return to South Africa. With regards to your second point, if residents are entitled from an exchange control point of view to take 1 million rand abroad as part of their single discretionary allowance. That arrangement is not in place for non-residents. So very technically, if you're a non-resident and you've got assets in South Africa and you want to remit that abroad, you always have to apply for a tax clearance to SARS, or an AIT, we call it.
Okay, so Werner, someone who hasn't submitted tax returns, does that mean they need to get hold of a tax consultant like yourself and submit all those nil tax returns in order to get the money out? And then what can parents do to help their children? What are you suggesting parents do to help their children that in the event of their death, the parent death, the money can flow freely out of South Africa?
Well, obviously, I just want to confirm my earlier statement. If you never entered the tax system, you don't need any permission from SARS, and you can apply to the bank to take the funds offshore. The problem is when you've got...
Which bank?
Any bank. We're talking about your authorized dealers, your local bank,
okay.
Any bank in South Africa.
But you don't have a bank. You've severed your relationship.
No, hold on 1 second. Sorry. The executor who's winding up the estate is sitting with an estate lay bank account, and the bank that's holding that account would be allowed to transfer those funds directly abroad without having to transfer it to a South African bank account. But those are for people that are properly non-resident and never came into the system. Where you've been into the system, as earlier mentioned, then it becomes a little bit more problematic, because then the bank says, I cannot transfer directly across into a foreign bank account. I can only transfer it to a local bank account. And in those cases, if you're not in good standing, in other words, you haven't filed all your nil returns or brought yourself up to date, you wouldn't be able to transfer the funds abroad, number one. And number two, remember, as a non-resident, you have to apply possibly for an AIT to get monies abroad.
Okay, Werner, we're going to continue with this subject. I've got a lot of emails that have come in about tax. We're going to take a short break. Stay tuned, and we'll be back shortly.